Nike Inc., trading under the ticker symbol NKE on the New York Stock Exchange, is currently priced at $60.02 USD, marking an increase of $2.68 or 4.67% as of the market close on Wednesday, December 24, 2025. Today, Thursday, December 25, 2025, the market is closed in observance of the Christmas holiday. This recent upward swing brings some much-needed relief to a stock that has been under intense pressure for the better part of 2 years. Yet the story behind this movement is far more complex than a simple holiday rally. While most investors are looking at the green on their screens and breathing a sigh of relief, the reality underneath the surface suggests a massive tug-of-war between high-level insider confidence and deteriorating fundamentals in the world's second-largest economy. The headline that caught everyone off guard this week was the disclosure that Apple CEO Tim Cook, who also serves as Nike's lead independent director, personally purchased 50,000 shares of Nike stock on the open market at an average price near $59. This isn't just a routine transaction, it's a $3 million bet from one of the most successful corporate leaders in history, signaling a belief that the bottom might finally be in. The common belief right now is that Nike is a broken brand, a giant that lost its way by leaning too hard into its own digital apps while alienating the retailers that made it a household name. You'll hear people on various investing sites talking about how the swoosh has lost its cool to upstarts like Hoka or On Running. But the reality is that Nike is currently in the middle of a massive structural pivot that most retail investors are completely overlooking because they're too focused on the short-term noise. While the general expectation was for Nike to continue its slow slide toward the $50 mark, the aggressive buying from Tim Cook and other board members like Robert Swan has created a psychological floor for the stock. This creates a fascinating tension because while the insiders are buying, the actual sales data from China, a region once considered the primary growth engine for the company, showed a staggering 17% decline in the most recent quarter. When you see this kind of disconnect between what the people running the company are doing and what the consumer data is saying, you have to ask yourself if the insiders know something about the 2026 product pipeline that the public hasn't seen yet. Looking at the recent stock movement, the volume on this latest leg up was significantly higher than the daily average, with over 36 million shares changing hands. This suggests that it wasn't just retail traders following Tim Cook. We are seeing institutional accumulation. When large funds move back into a laggard like Nike, they usually do so through an individual brokerage or sophisticated platforms like interactive brokers, often seeking to rebalance portfolios that have been dominated by high-flying tech names. If you've been tracking Nvidia stock or Tesla stock lately, you know that the market has been starved for value plays that aren't tied to artificial intelligence. Nike is starting to fit that description perfectly. It's a classic fallen angel scenario where the valuation has been compressed so much that even mediocre news can send the price higher. For those who utilize Schwab Intelligent Portfolios or similar robo-advisors, you might notice that these automated systems are starting to nibble at consumer discretionaries like Nike as a hedge against a potential cooling in the tech sector. Institutional activity has been a mixed bag, however. We saw massive firms like Wellington Management trim their positions significantly in the third quarter of 2025, yet the tide is seeming to turn as we head into 2026. The latest earnings report for the second quarter of fiscal 2026 was a perfect example of the expectation versus reality framework. The market expected a total disaster, with some analysts predicting an earnings per share miss. Instead, Nike delivered 53 cents per share against a 37-cent estimate. Revenue also slightly beat expectations at $12.4 billion. On paper, these are great numbers, but the stock initially fell because the reality of the forward-looking guidance was grim. Management warned that the third quarter would likely see a low single-digit revenue decline, largely due to the ongoing weakness in China and the persistent pressure of tariffs on North American imports. This is where the narrative gets tricky for someone looking at online investing options. Do you buy the beat or do you sell the guidance? If you're managing your own money through a self-investing app on a Robinhood app or a Fidelity trading platform, you have to weigh the impact of the Win Now strategy led by CEO Elliott Hill. Hill isn't just another corporate executive, he's a Nike veteran who came out of retirement to fix the culture. He has already started a major leadership overhaul, eliminating layers of management to make the company faster. Just this month, he removed the Chief Technology Officer and Chief Commercial Officer roles, signaling a move away from the tech-heavy focus of the previous administration. He is putting the focus back on sport and athletes, which sounds simple, but it's a radical departure from the data-driven, direct-to-consumer obsession that nearly ruined the brand's relationship with wholesale partners. Comment below how many shares of Nike stock you currently hold, or if you are waiting for it to drop back into the 50s before you consider an investment. The business model of Nike is essentially built on two pillars: demand creation through massive marketing and a complex global supply chain that delivers shoes and apparel to every corner of the earth. Historically, the company grew by dominating the wholesale channel. Think Foot Locker or Dick's Sporting Goods. A few years ago, they tried to bypass these partners to keep more of the profit for themselves through Nike Direct. That reality fell short of expectations because without those wholesale partners, the brand lost its always-on presence in local malls and neighborhood shops. Now, under Elliott Hill, the company is crawling back to those partners. Wholesale grew 8% this quarter, which is a clear sign that the strategy is working, even if it's hurting their profit margins in the short term. The challenge is that this turnaround is happening against the backdrop of global economic uncertainty. If you're looking at online investment help or checking out investing sites, you'll see that the biggest risk factor for Nike in 2026 isn't just competition, it's the $1.5 billion in annual costs stemming from new tariffs. For those using Fidelity Investments or SoFi Invest to build a long-term position, the historical context of Nike is important. This is a company that has survived countless cycles. Since its founding as Blue Ribbon Sports, it has pivoted through the running boom of the 70s, the Jordan era of the 80s, and the global expansion of the 90s. The current struggle is essentially a midlife crisis for a brand that got too comfortable with its dominance. Past performance shows that when Nike gets its product innovation right, like they did with the original Air Max or the Flyknit technology, they can command premium pricing that competitors can't touch. Right now, they're lacking that must-have shoe. They are leaning too heavily on older styles like the Air Force One and the Dunk, which are currently being sold at discounts to clear out inventory. This is why the gross margin took a 300 basis point hit this quarter. It's a painful but necessary clearing of the decks. The future outlook for Nike depends entirely on the next 18 months. The reality is that 2026 is going to be a year of transition. Analysts from firms like Goldman Sachs and Jefferies are divided. Some have lowered their price targets to $77, while others see a path back to over $100 if the China market stabilizes. The expectation is that the 2026 World Cup and the upcoming product launches in the running category will act as catalysts. If you're using Interactive Brokers trading tools to look at the technicals, the stock is currently fighting to stay above its 50-day moving average. A sustained break above $65 would likely signal that the multi-year downtrend is finally over. However, if the China data continues to worsen, we could see a retest of the 52-week lows near $52. This is why many people are looking at Fidelity mutual funds or Fidelity ETFs that have a broader exposure to the consumer sector, rather than betting on NKE as an individual brokerage holding. For those who prefer active investing through a SoFi trading platform or a Robinhood stock trading account, the play here is about the swoosh regaining its cultural relevance. Nike has always been more than just a shoe company, it's a marketing machine. The reality of their current situation is that they spent too much time talking about digital transformation and not enough time talking about performance. We are seeing signs that this is changing. They are reinvesting in grassroots sports and signing new signature athletes to compete with the likes of Anta and Li Ning in Asia. The road back to growth in China will be long, especially with the rise of domestic brands, but Nike still carries a prestige that is hard to replicate. Whether you use Robinhood crypto for your high-risk plays or Fidelity IRAs for your retirement, Nike remains one of those foundational companies that either defines a portfolio or drags it down. In summary, the Nike story is currently a classic battle between a legendary brand's legacy and the harsh realities of a changing global market. The expectations of a quick turnaround under Elliott Hill have been tempered by the reality of structural headwinds in China and the rising costs of doing business globally. However, the aggressive insider buying from figures like Tim Cook provides